Ladies and jelly beans, boys and squirrels, welcome to another episode of the Block Thrasher Daily Crypto. I gotta come up with a new name. Maybe a Daily Crypto Rundown. I'm trying to think of something creative. If you have any idea, let me know. Also, I'm thinking about sort of reformatting the show just a little bit here at some point. I think what I want to do is I want to make a Block Thrasher Daily Crypto Rundown, everything that happened in crypto while you were sleeping, what you need to know, something to that effect, and just cover the news in a shorter format, like a 15 to 20 minute max, so that you can listen to that in the morning and get everything you need to know about what's happening, what's going on in the cryptocurrency space. Get all of the day's hottest, most important news, right? To provide that convenience for you. And then maybe have another podcast or just have weekly episodes that are deep dives that go into deeper issues. Maybe a coin highlight on a particular project. And of course, eventually I want to have interviews as well. Trying to work on a lot of different things and thoughts. So if you have any thoughts or suggestions or ideas, I would love to hear them. What do you want? Eventually, as the audience grows, I want to try to get some of the key players on and interview them, of course. So what do you want? Let me know. Send an email to info@blockthrasher.com. What type of content would you like to see more of? All right, love to do that. Going back to the ladies and gentlemen, boys and squirrels thing, it's so funny. It takes me back in time. It just reminds me of when I was a kid. Because there was this season of my life during high school that was sort of formative. I think I learned a lot of really great skills during this period of time. It was a season in which my family decided to work as pitchmen. Maybe you've seen it before. Maybe you've seen something on TV, some of the infomercials, or I'm trying to think of there were some of the big people, but they would demonstrate things like the chamois or the ShamWow or your Ginsu knives, or there were steamer. There was all these different products, right? And so this was before as the TV thing was just kind of getting launched. But we traveled the country. This was around the time that I was in high school, and would go to home shows and fairs and trade shows and sell these products as a pitchman. I did this when I was 16, 17, 18 years old, and I actually made really good money. But it was a really great thing to do because it taught me how to communicate and how to sell to people. It was super hard though, because it's like these people are walking by you just like fish in a stream going super fast, and they don't want to stop, and they don't necessarily want to buy what you want to buy. And the whole task was to get them to stop, get them interested, and get them to buy that impulse buy. Really challenging thing to do, but also really like character building, because you have to learn to set aside your emotions and the rejection that may come. And I think it was good in that way. But anyway, I remember one time early on, and I was pretty young at that point, where we went to one of these things, and I think my parents were working. It was this show in Quartzsite, Arizona. So in Arizona, I think during the winter, you have all these snowbirds come down in their RVs, and they all descend and congregate in Quartzsite, Arizona. And there's this huge show that goes on. It's like an RV show or something to this effect. Thousands of people just show up, and there's these tents, and people are selling products, and people are walking through, and it's actually quite a bit of fun. But there was this younger guy that was selling pots and pans, but he was really good at it. And one of the things he would say over and over again as he was starting his pitch was, "Ladies and jelly beans, boys and squirrels." And I don't know, it's stupid, but at the time it was funny to me for some reason. Maybe it was the way he did it, and that just popped into my head when I got started today. And you're all like, "Come on, what are you doing, man? Get to the crypto. Get to the..." Anyway, little memory there. So what's going on with the cryptocurrency market? I tell you what, the zeitgeist of the day is pretty much what it's been of late. Not much change, just a lot of up and down, still on this roller coaster ride. Trending sideways for the most part. Bitcoin is at 32,588 today, down 3.9% on the week and 2.7% in the last 24 hours. And the OnChain Analysis paints a similar picture. It's just, like I said, the zeitgeist is uncertainty. But before we jump into that and we talk about that picture that's being painted, and there's some disagreement right now going on, is the data between the analyst and their analysis of the data, because it's confusing. There are things that would make us believe that the cryptocurrency market is going to turn around and head back into a bull market, and then there's things that indicate otherwise. And so there's definitely some uncertainty there. The word of the day is zeitgeist. 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 It means this: the spirit of the time, a general trend of thought or feeling characteristic of a particular period of time. So you know, it refers more to the bigger picture, almost like worldview kind of thing, or just a general feeling or belief about a particular time. I applied it to the crypto market. There could be a zeitgeist about the market, but overall it's more the spirit of the time, you know. And certainly you could look at an example like the pandemic and COVID, for instance. And I was observing, I was actually out quite a bit during that season, whilst many other people weren't, just because of some of the work that I was doing, and observing that I would have described the zeitgeist at a point in time. There was a shift in the zeitgeist, in the general trend or thought or feeling of that period of time, that people were starting to become more there was more animosity, I would say, toward other people. There was a lack of kindness, I think, because what was happening was everybody was, you might have experienced this too, where you go to Walmart, let's say, for instance, and you're walking around the store and people were treating each other like they were the plague, you know, like that person's going to kill me if they come near me. And then with the masks, it was dehumanizing. And so it wasn't like even that was a person. It was like people were just viewed as a walking viral virus, you know, right? Like, and just this weirdness that started to occur. And I think it sort of, from my observations, and it's just anecdotal, but it started to kind of like create this zeitgeist of, you know, this feeling of just distrust even, or this dehumanizing type of thing. And it wasn't good. But anyway, that's the word of the day: zeitgeist. Zeitgeist. All right, getting back to the market. Let's see what's happening. What's going on here? Total market cap is down 3.4% to 1.39 trillion. So now we've seen almost a 50% decrease overall from the all-time high a few months ago. Market definitely suffering some pain at the moment. What's happening with Ethereum? Ethereum is down 10.5% to 1,983. Binance is 309. Cardano $1.28, also down 9.3%. Everything's down. XRP is 62 cents. Dogecoin has fallen quite a bit to 19 cents, down 14.8%. Polkadot 14.28. Binance USD, well, that's a stable coin, so that's $1, of course. Uniswap 1881. What is happening on the exchanges, though? Here's some of the data that I was alluding to earlier that is a little bit confusing because we're getting mixed signals here. CryptoQuant Quickie Take is a platform on which verified analysts share their take on crucial Bitcoin BTC metrics and their possible effects on Bitcoin price dynamics. And there's some stuff coming out of there. The stable coin reserves have taken a nosedive. So just to summarize basically what's happening, there's these two things going on. Bitcoin is leaving exchanges. It's been doing this for 18 months. So that's not necessarily something new. The amount of Bitcoin on exchanges has been decreasing, and that's continuing. However, currently, the number of stable coins on exchanges is also decreasing, and that's the more concerning metric because, in theory, generally speaking, when people are sending stable coins to exchanges, they're doing that to buy crypto, to buy Bitcoin. When the opposite is happening, it's a negative indicator because it could mean that people are not looking to purchase Bitcoin. But at the same time, Bitcoin is being withdrawn from the exchanges, so it's confusing. Typically, users, going back to the story from you today, Typically, users deposit their stablecoins to exchanges when a price upsurge is in the cards. Those stablecoins are used to buy cryptocurrencies, as I just mentioned. As the Bitcoin price fails to grow, decreasing stablecoin reserves may be interpreted as a sign of purchaser weakness. Thus, every Bitcoin sent to an exchange emphasizes the danger of selling pressure. Meanwhile, other analysts opine that the Bitcoin number on exchanges is also shrinking. They claim that this trend is dominant as it has been registered for 15 months in a row. According to Glassnode data shared by the Bitcoin Archive, Bitcoin have been leaving exchanges since early 2020. This tendency only ceased for a number of weeks. Okay, I already mentioned all of those things. So we're getting mixed signals from the on-chain analysis. Now, the other thing that's going on that everybody is sort of debating about is this issue with the Grayscale GBTC, the Grayscale Trust Fund, right? Because what happens here, if you're not aware with the GBTC fund, is when people buy Bitcoin through that fund, it gets locked up. It's locked for 6 months, so they cannot sell it, right? So you're buying it to hold for 6 months. Then it gets unlocked and you can sell it. So here's the thing, about 40,000 Bitcoin worth more than 1.32 billion will be unlocked from the Grayscale Bitcoin Trust this month, right? So that's coming up. And so in theory, that 40,000 Bitcoin could be sold by those investors. JP Morgan analysts believe that this could be a bearish catalyst since it gives holders a chance to sell their shares. However, two prominent and well-respected analysts, one being the CEO, Bankman-Fried is his name, CEO of crypto derivatives exchange FTX, and Willy Woo, disagree with that analysis. And here's what they have to say about that. Also, Celsius Network Chief, let's just go through this real quickly so that I don't mess anything up here for you all. Investors who buy GBT shares have to wait for 6-month lock-in period before they can sell their holdings. We already mentioned that. Celsius Network Chief Executive Alex Mashinsky also predicts funds that want to capture price differences in the market, arbitrage opportunities, will short Bitcoin and purchase GBT shares at a high discount. According to the head of the crypto leading platform, the net result is $5 billion worth of sell pressure, which could drive Bitcoin below 30,000. So the JP Morgan analyst and Alex Mashinsky of Celsius believe that this could provide a lot of selling pressure and be bearish. However, Bankman-Fried tells his 217,100 Twitter followers that the unlocked GBTC shares likely won't have an impact on Bitcoin's price. So this is what he said. Remember, most GBTC creators are doing arbitrage. Most people getting long are buying in markets. So the unlock probability doesn't really matter for BTC. If people sell GBTC, most will buy BTC against it. And puts the caveat, not at investment advice. Who knows, anything could happen. So the point he's making here is that even if people do sell, the people that have the GBTC do sell it, that most likely they will buy Bitcoin with it, with the gains that they've received from it. Now, here's what Willy Woo said. He agrees with Sam Bankman-Fried as he predicts that the long-term impact of the GBTC shares unlock is neutral. He says the arbitrage opportunities presented by the unlock tend to balance out over time as the expected plummet in the value of GBTC shares incentivizes investors to buy at a discount. Here's something really important. Wu also dispels the confusion surrounding the coins involved in the GBTC unlock. He notes that no Bitcoin, here, get this, no Bitcoin ever leaves the Grayscale Bitcoin Trust once it is there. Grayscale is a unique product, says Wu. It's designed as a black hole that sucks in BTC. No BTC ever leaves the trust. Apart from Grayscale taking its 2% management fees from the holdings, this is the only way to reduce the GBTC inventory. And see, so that's why the arbitrage opportunity happens, because if somebody sells their GBTC, it still remains available in the trust, and it just drives down that price of the GBTC. And so relative to Bitcoin, if it's driven down below Bitcoin, people are going to sell the Bitcoin to buy the GBTC and vice versa, right? If it goes up above and it becomes a premium, then they're going to do this, they're going to do the same thing, right? So interesting, and we will see what happens. Only time will tell which of these analysts are right. All of this could mean, looking at what's going on with this market and these current prices, that some buying opportunities could be presenting themselves. Apparently, the hedge funds agree. Hedge funds see the crypto market decline as an investment opportunity, this being reported by Cointelegraph.com. From rebalancing cash positions to announcing new investment products, hedge funds seem undeterred by the current crypto market decline. Crypto market capitalization is down more than 40% since its 2.5 trillion high back in early May, but institutional investors continue to pile into the market despite Bitcoin losing over half of its United States dollar value and altcoins taking almost 70% on average. Big money players like hedge funds are still taking up digital currency investment positions. And this is the reason why we might not see the kind of crash that we've seen before. I sort of think, as was mentioned earlier, some of the analysts are saying, well, we could still see Bitcoin go below 30,000. And of course we could. Anything could happen. I don't think we're going to see it go much lower, though. It feels a lot like this consolidation period has it's been going on for some time now. And if we were going to see it get broken and penetrate down even lower, through it and go down even lower, it feels like that would have happened. As we continue on toward the winter months, generally speaking, that's a better time for the market. And it just feels to me, right? Like that's not going to happen. Like we've seen the worst of it almost. Could we go down? Sure. I mean, obviously you can't predict the market, and this is not financial advice, but that's my take on it right now. As regulated entities continue to explore digital currency investment options, crypto regulations also seem to be taking shape in many jurisdictions. Meanwhile, in the U.S., regulators such as the Securities and Exchange Commission are coming under significant pressure to enact a stricter legal framework for cryptocurrencies. Yeah, probably by these hedge funds and institutional investors, because, listen, what does regulation mean? It's always done to protect the small guy. That's the stated reason. But what it ultimately means is that it builds into the system guarantees that the large companies, the corporations, the institutional investors have an advantage, generally speaking. So it's sort of a double-edged sword, because you can protect little people by not allowing them to be involved. That's one way. But then also that destroys opportunity for people who, maybe they are well informed, maybe they full well know the risk that they're taking and want to take that risk because of the possible rewards. In any event, the evidence shows that the hedge funds, and I'm not going to continue on with the rest of the data, they outline it here in the article, but it's not important for us. They continue to see crypto as an investment opportunity and are piling in. Now, this is interesting. TikTok has actually banned crypto promotions amid concerns over targeting of young users. So this doesn't mean that the users of TikTok, which is generally actually the problem, who are pumping all and the meme coins, aren't going to be able to do that. It just means that branded content, people that are paying, running ads and that sort of thing, are not going to be able to continue to push crypto or get quick rich schemes, that sort of thing. And, I don't know, mixed feelings here. I mean, anything like this that's sort of a quelling of free speech is a little bit concerning. I know it's a private company, so they can do whatever the heck they want to, obviously. As platforms, I would like to see them lean more towards openness, rather than shutting things down on the one hand. But then on the flip side, there is an issue there with a lot of people being misled and making mistakes. But then again, it's sort of like no pain, no gain. If you don't go through that process, you might learn, and people are experiencing that now with some of the meme coins, where they got stupid and, you know, most understood, I think, what the risks are, though. But it's a tricky one here. But this is a move that TikTok has made, so we'll see. We'll see what happens. I know that Facebook has done similar things in the past, and Google as well, and often they've retreated and retraced, kind of come back around because they want those advertising dollars. We'll see what happens there. All right, wrapping things up here, moving into our discussion on inflation, the insidious thief. Today we're going to talk real quickly about monetary policy and how the central banks try to keep inflation under control. Moving into our education segment here. This information is being brought to us by Kraken. Kraken has a branch, a department, or whatever you want to call it, a team that they call it Kraken Intelligence, that does this research. And this was some really good data, and I want to just use it as a launch point for discussion for us. Central banks are known as lenders of last resort because they're responsible for providing financial capital to commercial banks for both day-to-day business operations and during periods of financial turmoil. Specifically, they're responsible for maintaining full employment and managing reasonable rates of inflation. Most central banks closely monitor the inflation rate and set an annual inflation target of roughly 2 to 3%, which they believe promotes a certain level of spending while stimulating sustainable economic growth. All right, so here's the stated objective. The reason we have a central bank. The stated reason for, now this may not be the actual reason. Obviously, I don't believe it is. I believe the real reason for a central bank, I've talked about it before. We've gone into it in depth, and I'm sure we will again, but you need a central bank to have a fiat currency to be able to allow government to spend without restraint. It's what enables the funding of wars and massive government growth and expansion. And it's a mechanism that provides a higher level of control, not just of employment and inflation, which are the stated objectives, but in the ability to determine winners and losers, which companies and which objectives will succeed and which will not, right? But that's the stated objective. The central bank exists to try to keep employment levels at full employment and to manage reasonable rates of inflation. And as stated, the target is roughly 2 to 3%, right? Because they believe this promotes a positive level of spending and stimulated sustainable economic growth. But see, the thing of it is the argument would be, at the same time, it devalues the purchasing power of the currency, right? So that inflation pushes up prices, but then when you increase the amount of money, the net result is that people make more money, but they spend more money. Like it's all an illusion of growth, because if your purchasing power is actually decreasing, if you're able to buy less things or own less things, that's what it really boils down to at the end of the day. And so one has to ask themselves, are people actually better off, making $100,000 today than they were making $10,000 50 years ago or 30 years ago? And that's where the real truth lies. Notably, central banks haven't always set inflation targets. Germany and Switzerland first used inflation targeting in the mid-1970s to revive the economy following the collapse of Bretton Woods. Roughly 20 years later, Canada, the UK, Sweden, New Zealand, and Australia followed suit in adopting the inflation targeting policy, along with many emerging economies. The US didn't adopt inflation targeting until January 2012, after the fallout of the 2008-2009 financial crisis, the Great Recession. A central bank also acts as the regulatory authority of a country's monetary policy and controls the production, distribution, and reduction of the nation's money supply. Put simply, a country's central bank maintains the integrity of the banking system and prevents it from falling apart. This is done by either expanding or shrinking the money supply and providing liquidity buffers as needed. The process by which central banks control the money supply varies depending on the central bank and the nation's economic situation. Some of the most common methods that central banks utilize to control the money supply include changing the central bank's discount rate, that is the interest rate between the central bank and domestic banks, setting reserve requirements, which is the amount of money a bank is required to hold against customer deposits, which, if you aren't aware, is almost nothing. Banks have to hold very little, like 1, 2, 7%, whatever it is currently. I'm not sure. We'd have to check, but it is a very small amount. They do not have to hold your deposits, just a very, very low percentage of it. Conducting open market operations, buying, selling U.S. Treasuries, reverse repos, quantitative easing. So these are the mechanisms that the central bank has at its disposal. I think we'll save examining these for next time. We'll look at modifying the discount rate, the bank reserve requirements, and the open market operations, quantitative easing, tightening, and these sort of things. The repurchase agreement, repo operations, etc. The mechanisms that the central bank has at their disposal. And see, here's where it gets concerning, is when those mechanisms begin to fail and they lose control. That's when you get into really bad waters. Okay, friends, thank you so much. Appreciate your time. I did not mention the reason for not having a podcast yesterday, which was simply that I had technical issues and was not able to get it done. Apologize for that, but I will be here every single day bringing the Block Thresher. What are we going to call this thing? Daily Crypto Roundup? Got to find a new name. All right, love and appreciate you all. I hope you have a great day, and I will talk to you tomorrow. Press on now. Remember, it's always a great day to earn and stack more crypto, and right now might be even an especially good time with these low prices. Peace out, friends.